Hello, today on the final bar, we'll talk market distribution. Today's a choppier day on Friday. Certainly, opened higher, really dramatically went down through the morning hours. I think it left a lot of investors wondering where a bottom would emerge, but the market put its rally caps on in the afternoon and finished today flat to down. So we'll call it a mixed day of sorts, but overall certainly more distributive than positive. We're going to wrap the week today and really break down what today's session and what the last 5 days sessions means for the overall trend evolution. Ladies and gentlemen, this is the final bar. Good afternoon, everyone. Welcome to today's edition of the Final Bar on a Friday afternoon. This is Dave Keller, Chief Market Strategist at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the action of the day through the technical, behavioral, sentimental lens, try to make sense of things and connect the short term with the long term. And Fridays, the goal really is to take a step back, do what we call wrap the week. And Friday after the close, we've locked in the weekly close. We've locked in all 5 closes for the trading sessions of the week. Let's look at how the last 5 days have evolved this changing picture of the market environment. As we've talked about overall in the last couple of weeks, it's been this transition of sorts from a raging bull phase to a consolidative, more negative phase, with the big gap down last Thursday really setting the stage for this week, which was a bit of a digestion week, right? Today in particular had a little of everything. It had a gap higher, it had distribution during the day, had retesting the close from yesterday, but overall more distributive. And so we're going to talk about that internal weakness that we saw today and just see how much the big picture has really evolved. In terms of what's coming up on StockCharts TV, we had some fantastic guests this week. I was really happy with some of those conversations, getting different takes on the market environment. Next week, more of the same. On Monday, Tony Hansen is joining us on Behind the Charts. That's our interview style show talking about price patterns, about the mental game of investing and understanding price movements. So that was a really cool interview with Tony Hansen. On Tuesday, joining us on this show, the final bar, is Sam Burns from Mill Street Research in Boston. On Wednesday, Chris Brecher from Brecher Trading. And Thursday, Joe Duarte. Joe's one of our newest contributors to StockCharts.com, has done such a fantastic job. He's actually hosted Your Daily 5, which is another show we have every day, every afternoon here on StockCharts TV, where a different guest contributor sort of presents 5 charts of interest to them. So check out some of Joe's work there. We'll hear from him on Thursday. Also, as a reminder, just jot down in your calendar, the week of July 13th, the whole week is called Charting the Second Half. We're going to have all our StockCharts contributors, a bunch of special guests providing some keynote presentations, some special events, and also we'll finish the week with a panel looking at the next 6 months and what they may hold for investors. So let's get into this weekly wrap where we wrap the week. We try to make sense of what has happened. Again, Friday afternoons are great for that now that we've locked in the Friday session. I did want to start with a poll. If we talked yesterday, one of our 3-in-3 charts was the AAII survey results, and that's a weekly survey of individual investors. We had the idea of just sort of recreating that idea with our StockCharts viewers. So we asked all of you, are you bullish, bearish, or neutral on U.S. stocks for the next 6 months? Here are the results over the last couple of days. 48%, almost half of you said bullish on stocks in the next 6 months. 24% bearish, 28% neutral. So interesting, about 2 to 1, almost exactly, bulls to bears. And that's actually very different than what we're seeing on the AAII poll, which is leaning much more bearish. What's interesting is, the time frame I think is key, right? Some of you, they answered bullish in 6 months. If you think about it, we could drop significantly for the first 3 months, recover beautifully for 3 months, and we'll finish up maybe a little more positive, in which case that might be a bullish answer if you're thinking 6 months out. So there's plenty of uncertainty in that sort of time frame, which I totally understand. But interesting to hear that all of you, on average, about half of you, leaning more bullish at this point. Now, I have to tell you, as a trend follower, I can totally see what you're saying. The trend overall has been positive. There've been so many, charts. Think of the average technology stock is holding up very, very nicely. Semiconductors, software companies, hardware companies. There's a lot of decent charts, a lot of stakes breaking out. Having said that, I'm always looking in this sort of environment for signs of internal weakness. I think in the last 5 to 7 sessions, we've seen some examples of where there's some chinks in the armor that we want to pay attention to. Let's dig into that a little further now. In terms of how things sort of played out, the S&P finished down 0.5%. If you look at the short little quick preview chart, you can see the huge gap out today. And I know checking the futures before the open certainly felt like this was going to be a big finish into the end of the week. But then you saw how things rolled over very quickly. And again, a lot of news flow about Apple shutting stores down, about concerns about that, about Fed announcements and all of that. So plenty of potential drivers, but certainly there was a weight on the market as it went below zero right around lunchtime. Since then, it's sort of chopped around in negative territory. At the end of the day, the S&P finished down about 0.5%. Mid caps the same. Small caps down a little more, about 1.3% or so. The Nasdaq 100 ended up flat actually, and spent much of the day in the positive territories. Came back to close right around flat for the day, and the VIX back up to just above 34. In terms of bonds, the TLT actually opened relatively weak and then just sort of improved through the remainder of the day. Finished right about at the close for yesterday, sort of a rounding error, and the 10-year yield up just a little bit to 0.7. Oil prices up higher today, gold up higher as well. So the commodity complex as a whole pretty much in the green, showing some positive rotation to that particular asset class, those assets on that list. Let's look at a chart of the S&P 500 as we begin to think about the implications of what's happened this week. When I look at a chart of the S&P, short term certainly has felt more distributive than positive. And the reason why I'm saying that is I'm seeing a lot of days where we're closing below the open. Only 2 out of the last 7 sessions have closed above the open. So that, during the day, you're seeing more distribution than accumulation is how I would think of it. After the big gap down last Thursday, Friday into Monday sort of traded around the 200-day, but bounced up. And as we talked about earlier in this week, I think this week's move certainly would satisfy both sides. If you're bullish, this feels like a buyable dip. If you're bearish, this could feel like the first leg of a multi-leg move down. I think today's close and the last couple days, you look 3 of the last 4 days closing below the open, we've now established a bit of a short-term sort of reaction peak here just above 3150. And I think remaining below that sort of makes the market certainly feel sideways to down. And I think the intraday distribution is what concerns me more than anything on a short-term basis. Having said that, you have to acknowledge the fact that overall the trend remains positive. Higher highs, higher lows. And even though this gap down was significant, we sort of stayed right around that previous swing low, this gap from the end of May. So overall, still in a positive range until we establish a lower high, which potentially we have. And I think going into next week, if we sell off a little further and we see 3150 as the new lower peak, I think that could be a bit of a concern. And then the follow through would be breaking below the swing lows from last week. So at this point, if I had to say anything, it's sort of neutral, which is about where we started the week, to be honest with you, coming out of the gap down last Thursday. I did want to point out very quickly, one of the things I added recently was just looking at some of the weekly changes to get a sense of how the markets have evolved week to week. Thought it'd be an interesting way to just sort of make sense of things. It's just looking at returns during the week. So the S&P actually finished up 3.7%. If you look at the TLT bonds down 1%. This is the dollar up 0.6% in the form of the UUP, the commodity index up 2.2%. Gold flat for the week, and oil was the best of the group, up 6%. Looking at some other asset classes here, we'll rotate to cap tiers. So this is looking at large versus mid versus small. So here's the S&P here. We're going to rotate to a relative call. So if the S&P was flat up 3%, mid caps outperformed by 0.25%, small caps outperformed by 1.6%, micro caps outperformed the S&P by 2.5% this week. On the downside, global markets actually underperformed as a whole, with EFA underperforming by 0.5%, EM down 0.8%, and frontier markets up just a little rounding error. So, this week, for example, actually, the S&P was up overall, again, finishing weaker today, but overall up from last Friday's close. And worth noting that small caps and micro caps actually handily outperformed large caps over that period. Finally, we're just going to look at a sector performance. So all using the perf charts, which is basically a performance chart where you look at a period of time and then you set the schedule. So you set the time frame. So here the S&P was up 3.7% in the last week. Let's stabilize that. We've now normalized to that value, and we can see what sectors have outperformed or underperformed for the last 5 days. Top sectors this week were technology, materials, financials. On the downside, utilities were the biggest loser, underperforming by 3%, followed by healthcare, and followed by staples. So it's interesting that consumer discretionary, which had been an interesting emerging theme up until last week, I feel like that's come off a little bit with other sectors sort of rotating around that. And technology is certainly the biggest winner. Tech, I think, we were starting to see a potential rotation away from technology. It felt like maybe that was ending. But this week, I think in terms of what we learned, semiconductors, resilient, outperforming. The XLK as a whole, resilient, continuing to outperform. So in terms of a safe haven during this period of uncertainty, tech certainly appears to be continuing to fill that role. Let's switch gears and go to the Mindful Investor Live chart list. This is what we love to do every Friday, start at the top and go down through it. So I update these charts at the end of the day. I have not done it yet today, but what's interesting is as of this moment, as of Friday's close, all three of these trend following devices that I follow using the weekly chart, all positive now. So the long-term model now has confirmed a positive reading, and this is based on the 21 and 34 week exponential averages. The medium term, which is using the weekly PPO, has been positive since early May and remains so. The short term, what I use is just look at the change in that and the gap between these moving averages, just a short term read, and that has turned positive as well, just with this week closing above last week. So, if you look at the weekly chart, it doesn't look as bad as I feel like on the daily chart, right? Because on the daily chart, you're getting the intraday movements. You're seeing how we're closing below the open so much in the last week and a half. And for me, I think that's a big part of how this environment has felt, even though we're up Friday to Friday, this Friday from last Friday. Overall, it's the distribution during the day that feels more negative. If you look at the bar chart, it's actually more of a positive read. It's not quite closing halfway through the previous bar, which would make it a bullish candle pattern. We didn't really get that. We closed just below halfway above yesterday's body, the open to close range from last week. But overall, certainly trading higher during the week, trading off of these long-term moving averages. So the long-term trend remains positive, I think, by that read. The daily chart we've talked about, a bit of a distribution day. This looks a bit like a bearish engulfing pattern. It's not as idealized for me because that you'd really want to see after the end of a big move. This is sort of in the middle of a congestion range. I don't think you can make it feel as much of a bearish engulfing pattern, but I do very much notice the potential for a lower high here in that 3150 level. Going into next week, I think that's a level I'll certainly be paying attention to, not just on the broad market standpoint, but also looking at individual stocks and seeing if they're able to break above the swing highs that we set this week. This was a chart that we talked about on our 3 and 3 yesterday, which is the cumulative advanced decline lines. It's too early to certainly say this is a bearish signal, so don't misinterpret. I'm not saying this is a sell signal of sorts. I'm anticipating when we potentially would get some sort of divergence or some sort of distribution. For me, when this indicator is making higher highs and higher lows, when it's in an uptrend, the breadth overall remains positive. It's interesting to note that this week, they've all appeared to have set a lower high. That could change next week. If we rip, this will just look like a continuation pattern. So it's too early. What would not make it too early and would confirm that it's a lower peak in a distribution is if we break below the peak that we set from last Thursday's sell-offs. This is the distribution you saw last Thursday across the board here, large to small. And if we would break below that next week, that would certainly make the breadth picture turn more negative. Has not been the case. Very few new highs, very few new lows, if not zero new lows. I mean, it's been on your hand, you could count the number of new lows on any given day. It's been minimal on the S&P 500, and that's because most stocks are in this range, right, between their 52 weeks highs and lows. I think it is worth noting, though, during this whole period over the last month, you have had stocks breaking to new highs. It's things like Shopify and KLAC and all these other names that we've talked about on the show. Yesterday, if you missed it, we talked about stocks breaking above their upper Bollinger Bands. A lot of names making new 52-week highs or close to that, to that metric. Those are the names that would appear on here as stocks making new 52-week highs. So they are out there. You have to screen for them. You have to look for them because the broad market index is still not there. The next chart we've talked about a couple times this week, and this is the percent of stocks above key moving averages. For me, we remain below the 50% line. This is the percent of stocks above their 200-day. This is not quite updated for today yet. I don't see that changing, though, based on how the market, sort of distributed during the course of the trading day today. But overall, if and when this remains above 50%, that tends to be more of the bullish range. That's where bull markets tend to be. When we're below 50%, that tends to be the bearish phases. And so right now we've had whipsawed. We whipsawed above the 50% line, and now we're back below. So as long as that remains below, I'm sort of thinking, leaning more negative looking at that particular read. In terms of the sentiment, just one thing to point out, the AAII ratings, we talked about this yesterday, rotated in a big way, almost a 20% rotation from people moving from the bullish vote to the bearish vote. That's a big shift. And I think a lot of that, obviously, a reaction to last Thursday's sell-off. This comes out every Thursday, so it could be any time between those two Thursdays that you had the reaction to that, but certainly rotating more toward the bearish side. It's almost 50% bears in the AAII survey, which tends to coincide with previous, pullback lows, but it also coincides with the beginning of much deeper corrections, which is why I can't go out and say that's a huge raging buy signal of sorts, but it's certainly worth noting and worth tracking. The final chart we have time for to wrap the week is looking at this chart in particular. This is the ratio of consumer discretionary versus consumer staples, potentially putting in a lower high, potentially rolling over to not quite break down today. But I think it's worth noting on an equal weighted basis, we have already broken down, suggesting a rotation away from consumer discretionary. And this is a ratio looking at consumer discretionary versus technology, never really broke to a new swing high and now coming off a little bit, just speaking to, again, the resilience, the outperformance of the technology sector. That is our Wrap the Week segment for a Friday afternoon. We're going to take a quick commercial break, back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, StockCharts.com, Chief Market Strategist. Thanks for joining us every weekday for the Final Bar. As a reminder, we love answering your questions. We love hearing from you. Feedback on the show. Also, guests that you'd like us to have on. We have a great group of guests that we've been able to bring on, and we are booking weeks ahead of time, bringing on some fantastic people with great points of view. If there's someone you'd like us to interview, just shoot us an email, thefinalbar@stockcharts.com. Let us know. We'll do our best to get them on the show and ask them some questions for you. Also, any questions about the markets, the charts, anything is fair game, just let us know. Question number one comes from Dubai, and thanks so much for watching the show. You mentioned it's part of your morning routine, which I very much appreciate. I'm summarizing your question because it was very, very thorough, and I just want to briefly hit on it. Basically said, I recognize that many stocks, including the Fangman stocks you talked about, have a divergence between price and RSI, and you're talking in particular on the monthly charts, on the long-term charts. What do you make of these monthly divergences? How do you read these? What's the right approach to mitigate risk and not to miss the current trend and price appreciation at the same time? And I love the way you phrased your question, which I think is exactly right. When you look at divergences, you have to remember that a bearish divergence, which is what you're illustrating here, and this is your chart that you sent. It's very nicely designed, by the way, and you're showing me Microsoft relative to the S&P. And again, I'm taking a step back on the monthly chart and looking at how that has gone vertical is pretty impressive over the last 20 years for sure. Here's the MACD. Again, this is based on monthly data, so really long term. Here's the monthly candle chart. This is what you're asking about, the RSI. So as the price of Microsoft is going higher over the last couple of years, the RSI is sloping downwards. And I think the answer to your question lies in the question itself. what's your view on it? But how do you read these? What's the right approach to mitigate risk and not to miss the current trend in price appreciation? So something like this, a bearish divergence is really what I would consider a leading indicator. If you think of the technical toolkit, you could really separate them, broadly speaking, into leading indicators, things that are trying to anticipate a turn, and lagging indicators, things that are more conformational, or things that try to confirm once a turn has actually happened. In general, my approach tends to be more as a trend follower, and I think that comes from time spent as an institutional investor. You really, with the amount of money you're managing, you have to be a trend follower in a lot of ways, because that's where the liquidity is, and that's how you overall are able to do your job and outperform over the longer period of time. It's focusing on outperformance and what stocks are able to consistently do so. But there's a whole part of the technical toolkit that's designed to anticipate. RSI is one of the better examples of that, which is momentum. So you're trying to identify when momentum has become too strong, when something has gone too high too quickly or too low too quickly, and betting on a reversal. I think your chart of Microsoft hitting the overbought signal the first time over the entire 20-year period. This is right at the 2009 low. I think speaks to that leading indicator quality, identifying the turn. This is after it was overbought here in 2007, indicating the top. So there are times when it's incredibly prescient. What you've noticed here, though, is on the monthly charts of Microsoft and others, you've become overbought and remained overbought. And that's the challenge, right? Stocks can become overbought, especially on this time frame in an extended bull range, and they can remain that way for a long period of time. So the answer to your question is, I think things like this are good as a leading indicator. These help you anticipate turns. This is the kind of thing that would put Microsoft on my watch list of potential reversals. But I would be waiting for some sort of confirmation, some sort of indication that the turn has occurred, some sort of validation that the divergence is playing out. And so for me, it's looking at price, and it's looking for price breakdowns. It's a lot of things we would talk about looking at the weekly chart, looking at a rollover in the weekly PPO, which would confirm once the trend has actually reversed. It would be breaking down through a recent swing low, right? Breaking down through a most recent low. And ideally, if you hold a stock like Microsoft, you have a trailing stop of sorts, and you're moving that up along the way. So you're booking all of these paper profits. And then once we break down through that trailing stop, you've just lost on that, a little bit at the top here, leaving off that original, or sort of the end of the uptrend. So that's the way I would describe it. I think you're right. I think on a lot of monthly charts, you'll see that. But again, this is a 2-year period. There are career-busting moves if you try to anticipate a reversal and you miss out on the further upside. With something like Microsoft, I'm happy following that trend until the trend is no longer going up, because it's been so consistent, so strong over the long term. Really good question. Sorry for a somewhat longer-winded answer, but I thought that was really well asked, and thank you. Question number 2, you have a chart in your your chart list, 1200 equity index, titled New Dow Theory. What's that all about? Are you merely replacing the transports with the Qs, or is there something more elaborate here? Thanks for that question. So this is the chart list you're talking about. I use this pretty often, so I'm sure this is where this is coming from. And so this is a traditional Dow theory. So Charles Dow, 100 plus years ago, came up with this idea. He was the editor of Barron's, and he, sort of the father of technical analysis. He described these concepts of confirmation, which was the idea that markets move in trends, and the way you figure out when trends, get a read on the economy, is look at 2 different indexes. He started with the Dow Industrials and the Railroad Index. So it was the producers of goods and the distributors of goods. And at the time, 100 plus years ago, it was a relatively simplistic industrial system relative to what we have now, with it was people that produce things and then people that distribute them. And you would basically look for confirmation. If all of those companies, the producers and the distributors, are doing well, you're in good shape. If they are not confirming one another, then that means there's some sort of problem in the supply chain somewhere. It's an issue with consumers, issues with supply, whatever it is. But the non-confirmation, when one makes a new high and the other does not, that's a bit of a challenge. The problem, or the issue I have with that, is if you still use the Dow Industrials and the Dow Transports, the Dow Industrials are not just the producers of goods, it's the producers of services, it's banks, it's tech companies, it's communication services, it's a mishmash. Transports includes things like airlines and FedEx and other things. It's not just railroads or cargo carriers. So one of the, if the essence of Charles Dow's idea was to evaluate the different pieces of the economy, I sort of evolved it to say, okay, well, let's look at the S&P 500, sort of including all those large industrial and communication companies, and then to include the NASDAQ composite as the other piece of that, which would be all the technology, which more and more, I would argue, has become sort of half of the mental weight of the economic conditions in the United States. And so I'm looking at the two pieces of the economy, similar to what Charles Dow would have considered, but instead of the Dow Industrials and Dow Transports, it's the S&P 500 and the NASDAQ Composite. There's a book whose name completely escapes me that I'll try to remember and put in the comments on a YouTube video down the road to explain where I got this from. New Dow Theory, something like that. But that's what sort of led me to this idea, and that's what I've kind of continued to use. One more quick questions, perhaps. I answered a question on lows on our last mailbag segment. How would you identify that the trend has reversed? A good question. So something like lows, let's bring up this chart here. Right, so so the trend has been positive, which we've been talking about. It's made new highs recently, which we've talked about. What would tell you that the trend has reversed? So it's funny, the question earlier was on divergences, and I think you're seeing an RSI divergence potentially here with lows. I'm a little concerned in the short term about that. Right now, you do have a bit of a bearish engulfing pattern because it's coming at the end of an uptrend. These aren't huge wide days, but wide enough for me, telling me there's distribution and potential downside. But the bearish divergence is what's most concerning here. Higher highs in price, lower peaks in the RSI. So as I mentioned in the earlier response, that's what puts it on my radar. What I would be looking for is a break to a new swing low. So for me at this point, assuming you keep bumping up sort of your mental stop on each one of these pullbacks, and as we go higher highs, higher lows, every higher low, you sort of bump up your key level of support. So at this point, it's around 123, which would be the swing low from the second week in June. If and when we break down through that level, for me, that would suggest to to think more downside, more risk management. At this point, you have the unlimited upside of a continuing uptrend that has been resilient, and your downside is limited to 123, and that's fairly decent. Pinterest is the last one we'll talk about. And then we need to move on and wrap the show. Same thing with Pinterest. I talked about this in a 3 and 3 recently. Recently has broken through resistance. I think you're right. Similar concerns to what I just mentioned with lows, but you don't really have the divergence here. It's actually broken to new highs. What concerns me though is just today's candle. Again, we're asking this on a day when I think a lot of stocks are having this more distributive pattern. Over the weekend, I go through all the S&P 500 charts individually. And I'll be interested to see how some of these stocks actually look, because I'm seeing a couple of them randomly as I'm looking at lows with a bearish engulfing pattern. Looking here, which is a shooting star pattern, which I open and close near the lows and a higher upper shadow. So I'll be interested to see if you see other charts like that on stocks that have made recent highs, because that tells me going into next week to lean more on the short-term bearish side than bullish side. But that's what I'm seeing on now. Up until then, the uptrend has been fairly positive, and the relative strength testing a new 6-month high, which is impressive. Thanks so much. Those are all questions from you guys in the last day or two. Really appreciate them. Keep them coming anytime. We'll answer them as soon as we can. We need to wrap the show, folks. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P 500 with on-balance volume at the bottom. I don't use volume a ton, as you probably have noticed, and that's just it's gotten out of my toolkit as I've had a lot of issues, I think, with how volume is reported, how trades are reported. It means something different than it did when I was learning all of this 20 plus years ago. But what I would tell you is that on-balance volume overall has been confirming things. We've had a lower peak in price, potentially, a potential lower peak in on-balance volume, but look at how the on-balance volume has been positive, which means even though we've had distribution, the volume trend has been positive. What's interesting, though, is if you look at the last couple weeks, I'm seeing the volume trend going down. So during this consolidation phase, the volume is lightening, which usually means you're setting the stage for a breakout. And I'll be very interested, as we've mentioned before today, the direction of the next move, I think, will be key for momentum going forward. Chart number 2 is looking at some other sentiment gauges. We talked about the AAII chart earlier in the show today. Now we're talking about the name exposure, which is basically percent weighting in equities, and it's at pretty significant peaks. If you look back at the historical values, we're saying active investment managers leaning into equities pretty significantly on this week's read. Also, if you look at Ridex flows, people more in the bullish and sector funds as opposed to bearish and market neutral sort of funds, which suggests a lot of optimism. And that overall optimism tends to be considered more of a contrarian indication. So people are pretty bulled up position wise. That might suggest some internal weakness going into next week. Finally, we talked about this looking at some internal rotation. I talked about consumer discretionary, really impressed about the rotation away from staples into discretionary, but look at how that's rolled over in the last couple of weeks. That'll be an interesting trend to watch going into next week, because I think a lot of people have written off consumer staples, but certainly underperforming technology, which has been the long and strong winner. Folks, that is our show, and that's a wrap for this week on The Final Bar. Thanks for joining us every weekday after the close. Keep your questions coming. The Final Bar at StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.